Hey everybody, this is Michael Smith and this is The Lowdown. Inflation. This is the constant word we hear from everybody. Everyone's talking about it. We feel it at the restaurants, the grocery stores, big purchases, small purchases. So we're going to talk today about the latest inflation metrics that we're watching closely and the effect on Fed policy. So let's talk about CPI. This is the Consumer Price Index. We are now at 40-year record tops, 8% plus. If you go back to prior to the pandemic, this was below 3%. So just giving you some context. One of the top contributors to CPI has been auto prices, both the new and used. If you've gone out to get a vehicle, you know exactly what I'm talking about. And that's probably one of the biggest contributions we've seen to inflation. However, we're starting to see that pull back. So auto inventories, they're stabilizing, and this is a good indicator that inflation might be stabilizing, which is what we want to see at this point. So wage pressure is another top contributor to inflation. So why? Post-pandemic, we saw a mismatch in labor. We could not find labor. It was a hard time to getting people back to work. So for the first time in history, if you went to a restaurant, you saw where waiters or waitresses were able to come in and demand what wage they wanted to come back to work. Never have we seen that before. Now we're seeing labor force participation pick up, and we're starting to see labor come back into line where we were pre-pandemic. This is another reason we think this is a contributor to inflation that's subsiding. Let's talk about housing. For the last year, we've heard about record increases in home prices. It has been the best time to sell a house. However, that is changing despite what you've heard. Now we're seeing this is the worst time to buy a house. That is changing fast. This is another big driver in terms of inflation. If you think about it, the cost of housing is not a measure in CPI. The renter's equivalent rent, that has been another big driver of what's been bringing CPI higher. That should start to decline in the coming quarters as well. And finally, the most important, personal savings. We've had an excess of personal savings post-pandemic. However, you can see here, a lot of that's been spent. Personal savings is declining to pre-pandemic lows, and all that pent-up demand is now evaporating. This is another big sign that we're going to see inflation subside here. Less savings equals less discretionary buying. So what does that mean? Going forward, you're going to see the consumer lighten up and starting to buy less. So now, what does all this mean to the Federal Reserve? The Federal Reserve has a dual mandate. Think of the game Whack-A-Mole when we were kids. You know, you're trying to hit one thing down and all of a sudden two more pop up. That is exactly what I feel the Fed is facing now. As they've told us at the beginning of the year, the first thing and the priority they had was to combat inflation above all. Now, however, with the things that I've presented here, we're starting to see that the other side of the dual mandate could start to contract, and that is going to be employment. The big issue I think we have going forward is the economy could be slowing down and slowing down fast. One of the things that we're going to be looking at is the ISM. That's the Institute of Supply and Manufacturing. This is something that measures the viability of the economy. So then we give you some kind of benchmarks. Above 50, we're in expansionary. That's where we are now. As we start to breach basically 50, 47 is a recessionary. So that is where I think we're heading. This will be a key indicator as we're going to be watching in the future months and quarters to see, does that decline, and ultimately, could this lead to a recession? The Fed will continue to have a challenge, as right now they are going to continue to tighten monetary policy. The market has a lot of that priced in, but at what point do they have to pivot? Do they start to pivot? I think as we see manufacturing in the ISM, we start to see the consumer slow down, and we start to see growth of the economy slow down. That is potentially a point where the Fed is going to have to pivot and change course. But as for now, we think they'll continue to be aggressive in monetary policy, but be prepared for a pivot. And quite frankly, this could be something that happens very fast. Another question we're hearing is, given the rally we saw in May, is the bottom in? Even though the market is bouncing, there's some huge rebalance flows that are actually going through the market right now. And I think that's what's contributing to what we're seeing. So looking at the chart of the S&P 500, the forward price to earnings ratio, we've seen that decline pretty significantly. And while these might be attractive valuations, look at this in the context of the past. We're seeing some cheaper valuations. However, I don't know if the bottom's in. There is potential this could decline further. Now, retail investor sentiment, this is one I consider a contrarian indicator. If you look here at this chart, the bullish sentiment is at its lowest level of this chart. And if you look over here, the bearish sentiment at the highest level. This is one one I tend to pick a contrarian side to. So it's one, I think, again, a good contrarian indicator. And when retail investors get overly bearish, typically what happens, the opposite could happen. And lastly, let's just talk about 2022, the start of the year. This is the worst start of the year in over 50 years. On one hand, the S&P is off to the worst start in over 50 years, which could be indicating a bottom signal. But on the other hand, we're entering into a 6-month period where returns, historically speaking, are at their worst, May through October. The takeaway is the bottom in, and what are we looking for when calling a bottom? Everything centers around inflation. And everything centers on the response of the Federal Reserve to how they plan to combat inflation. So for one, if we continue on the path of monetary tightening, this is the path we're on. We've already seen the effect on equities. It's been negative. If we continue to see tightening, expect that we're going to have more negative effects on the equity markets. However, if the Fed does decide to pivot, if they start looking at the future growth of the economy and they decide to either stop, pause, or pivot, that's going to be a positive effect for equities. Be advised, the Federal Reserve can only do so much, so ultimately, stay in the confines of your financial plan.